Today we've got Scott Ferris with Hollis Wealth, and
Yeah.
Scott and I have probably known each other. I was trying to pin it together, maybe 20 years now.
Yeah, I think that's the number actually.
Yeah, yeah. And so Scott's been helping Betsy and I with our finances, and been a wealth advisor for us for years now. But we were looking over our portfolio a couple of days ago, and we had a great chat about where the financial markets currently sit and where they've been over the past couple of months and where they might be going. And I thought it was just a really kind of refreshing take on what's been happening, and with a little bit of a lens towards kind of the Vancouver real estate market and how that's been affected, going to be affected, and then of course that trickles up the highway to Whistler to a certain extent. So I thought that was a really interesting chat that we had, and I thought we could kind of recreate that maybe and bring that to our viewers and some of our clients. So if you could maybe take over from there, tell us a bit about yourself, Scott, and then maybe go into things.
Sure. Thanks, Dean. Yeah, I started as a financial advisor actually during a stock market correction and a recession in November of 1994 at the ripe old age of 22. And we've been saying with some of our longer term clients like you and Betsy that we've been through a number of these together with our longer term clients. Previous to that, it was 1987, but there was a rather significant market decline in 2001. And then obviously a large one that we all remember in 2008 and 9 with the financial crisis. And this latest decline is rather interesting because it's a little bit overdue to begin with. And the decline thus far has been from the all-time high in the history of the market. So we don't really see things as becoming cheap just yet. We think there's going to be a good and more about bad news to come that will cause valuations to come a lot more in line. So the analogy that we were using on our call and we use with a number of our clients is if you kind of compare the stock market to real estate in East Vancouver, where I live, houses in East Vancouver are about $2 million. And the market fell about 20% there at the end of February and through March. So that if you use the analogy of a house, the value of that house fell from $2 million to $1.6 million. That house is probably 60 years old. It's probably on a 36 by 106 lot. It probably needs $250,000 of renovations, and it probably has some asbestos in it, right? So the value is not really kind of there just yet for people to go, oh my goodness, I need to move to East Vancouver right this second, because they're going for bargain basement. We feel there's a good and more amount of value to come, definitely. The other thing we're kind of seeing in the market actually over the last few days and actually changing just today is something called a bear market rally. And this is pretty textbook. This happens in a lot of market declines where you see a very steep decline and then you see a rally of prices actually going up with people that are covering their shorts, people taking advantage of stuff that they've bought incredibly cheap. And then the market drops off again. This actually happened in December 2008. The market had plummeted all fall. It went up and people sat at Christmas. I totally remember that year saying, oh, well, that's all over. Everything's fine. And turned out it wasn't over. And it kept going down to the first week of March 2009. So patience is the number one thing that we want to make sure that our clients understand. And then the other thing is making decisions based on logic and data, not on emotion. So not buying on greed and also not selling based on fear. Those are usually the worst financial decisions.
Yeah. And you were saying that you're looking historically at things, you're looking at, this certainly isn't the worst of the sell-off at all yet. I mean, no one should be jumping on the wagon of, the things have dropped and let's buy a bunch of stock right now.
Yeah. So, if you think about it, if things were at the all-time high in the history of the world, well, that means that they're 20% down potentially, and you can't even really call them even cheap yet. They're not even value yet. One call I was on recently, the portfolio manager said, "Yeah, so you're speeding. You're driving down the Whistler Highway. The speed limit is 100. You're driving 120, and you slow down to 99 kilometers an hour, and you get in an accident. Really bad things are still going to happen. yes, you decreased your speed by 20%, but you were still going insanely fast, right? This is kind of what's gone on with the market here. And so the opportunity, we think, is going to come out when, after the market kind of feels that the world is containing or wrapping its head around at least the spread of COVID-19. We feel it's going to turn its eyes towards this massive oversupply of oil on the planet, and also how big this recession is going to be, right? And you're going to start seeing earnings restatements, guidance from publicly traded companies. You're going to start seeing probably significant unemployment in the Western world. And a lot of the Western world economies, as you know, are based on consumption, right? On buying stuff. And so those people don't have that cash flow to buy that stuff, and therefore the economy will contract, a recession, 2 quarters in a row, and spending will probably come, probably not to a grinding halt, but down a lot. And the market should sell off due to that data. And that's where opportunity for the people who have patience and are doing good research can really pay off.
We haven't really seen the tip of the iceberg yet then.
I don't think we have, because we haven't really seen the big unemployment numbers out of the United States, especially in these incredibly dense populations where sadly the COVID-19 is spreading very fast, and they're not containing it very well. And sadly, you're seeing a lot of people pass away. Also, the sort of backward thinking of everything's fine, everything's okay, this doesn't really affect me. That mentality, since we don't have a vaccine for this virus, is going to cause a lot of problems in their economy and in their society, which in a number of societies will spread around the world.
Interesting. Now, going back a little bit, we talked about this a couple of days ago, about some of the triggers and what really happened in sort of November, sure, December. And this was before we saw anything change in the markets, but there was a couple of things that happened.
Yeah, I think a couple of really big things happened is we saw this, all of us saw this happening in Asia. And I don't think we put enough weighting on it, maybe didn't prepare ourselves enough for it. Also, a number of people who run risk management, when they run risk management, they run different models, different scenarios. What if interest rates rise? What if interest rates fall? What if there is a trade war that expands? What if there are tariffs? What if there's a physical war? So they run all these models to kind of manage investors' expectations on here's what could happen. And sadly, not too many people were running models on pandemics and what could happen there. And what we feel is this is really just kind of the catalyst for the market fall, the repricing of the market, and the recession that was both of which kind of quite overdue. People invest in the market based on forward free cash flow, based on forward earnings. I want to buy this company because I think it's going to make more and more and more money. That's going to pull the share price up, and I'm going to sell and make a lot of profit. And so when we were looking at those earnings and comparing them to the prices in November and December, we were scratching our heads a lot and saying to our clients, this seems to be really, really expensive. We don't really see where all these forward earnings are going to come from. How much more can you squeeze out? Also, a lot of people were speculating the market on margin, right? And so when you started after February 20th, seeing margins get called, people had to pay their margin back to their stock brokerage firm or their stockbroker. They didn't really want to sell they feel their profitable equity portfolios, which were down a little bit. So they sold the stuff they could sell the fastest. And they mainly sold their AAA government bonds, their AAA corporate bonds, and their treasury bills because they needed cash. So end of February, March was very, very different than 2008 and 2001, where those two previous market corrections were a flight to safety. This is very much a flight to cash. What was so fortunate this time compared to the 2008 time is central banks and governments responded incredibly quickly and with an incredible volume of capital. So they stepped in only 6 days really after this had started, the sell-off, and said, hey, you guys want to sell your bonds? We'll buy them from you. Even the corporate bonds this time, which is the very first time in history, the Fed at least, has bought corporate bonds in the marketplace. So being a market maker and someone that's able to provide that cash, that liquidity for the people that needed it. So that was kind of the biggest triggers of this. Sadly, pensions got pulled into it when they needed to rebalance because they needed cash to pay their pensioners, right? Their fixed incomes, their bonds had just plummeted in value. Spreads had massively widened. So that perpetuated it a little bit more. Eventually, it all kind of settled down. And a lot of people jump back into the market trying to take advantage of this. And maybe not making decisions based on data or any earnings, true sort of new earnings numbers or restatement of forward earnings, making decisions completely based on price. Right? So that worked really well as long as you got out of the market over the last couple of days.
Now, as we go ahead from here, any ideas of what's to come over the next summer or into the fall?
Yeah, obviously we need to all continue to work together to help manage the spread of COVID-19. I think it's sort of massively important to pay attention to. We need to pay attention to our liquidity, our access to cash over the next 90 days, 180 days, and so forth, so that we can keep our fixed and most of our variable expenses going. These are the things we need to look at. And then we need to wrap our heads around not just unemployment numbers and bankruptcy numbers and defaults on mortgages, but we also need to start wrapping our heads around, they talk about this in the media a lot, especially a lot of analysts talk about it, the new normal, right? For a given company, a given industry, what will the new level of earnings be moving forward? Things will be different, right? And what we've also proved to ourselves, I think, in all of this, in your business and definitely in ours, is maybe we don't need some things in our businesses. Maybe we can get along just fine without some stuff, and we can be more efficient with it.
Yeah.
So I think what we're looking for, those earnings restatements, the guidance, those corporate guidance, we're looking for the bad news. Significant more unemployment, which is going to slow everything down, and the market seems to always be inefficient. It goes too far up, which is what it did. Now it's going to go too far down, and we need to make sure that we're involved in as it goes down, not trying to time the bottom, because no one does that well. We need to make sure that we take advantage of mispricing of investments, so we can buy something significantly below what it's worth.
Yeah. And as far as that goes with the real estate market, and in Whistler in particular, what we're finding right now is, if you look at the 45 days prior to the sort of the March period where COVID really hit here, and you compare it to 45 days since then, we're now sitting at half the transactions that we've done, which is pretty typical given the situation. But we've had quite a large proportion of them were big deals above $4 or $5 million.
Yeah.
So I think that people with money are still, making those discretionary spends and just going ahead and doing it, because why not?
And I think on a number of things, a client of ours who spoke this morning that works in the sonar business, and he said, yeah, we've had a phenomenal March. My Q1 is awesome. And what he had kind of said is, those were deals that were already in the hopper, right? Those are deals that were already, people already made their buying decision. They weren't making their decision exclusively on price. They're making on many other things that they saw value, right?
Right.
In their decisions. So moving forward, as price becomes more and more an issue, also people's ability to manage debt, being in a position where they actually are forced to sell some assets to maintain some other things. For the buyer, that's opportunity, right? As demand should rise during a time when, especially if you have good liquidity and access to capital, you can take advantage of again, mispricing of risk.
Yeah. Yeah, it's an interesting situation. I mean, will that change as we go forward? Will it be different next year? As the financial kind of crisis or meltdown progresses, will people's decisions really change? And I think that they will.
I think they're going to be forced to change, some of them, right?
Yeah.
But if you look at sort of a little bit what happened to real estate in 2008 in Vancouver, prices fell 32% over a very short period of time, based on a couple of things. I don't know if I want to make that transaction, client saying. And then number two is, the banks stopped lending. right? Because that problem that in 2008 was a physical problem. Banks
Right.
weren't lending to banks, and a bunch of people had defaulted on their mortgages that in tools that have been securitized, um, physically broken. We haven't seen that yet, right? So at first it might be a little bit of not hoarding, but do I want to make a big decision like that? And then the second level is like, wow, I need to rely on leverage to actually do this decision, and I can't get the leverage I thought I was going to get. Or maybe I was borrowing against the value of these equities, which have fallen 25%. So I can't use that as much.
Right.
So that's going to, that is going to create, again, opportunity for the people who understand the value of something because they've done their homework. And they're not making a short-term decision, right? They're making a mid to long-term decision with their equity.
Yeah. And there's also the psychological aspect of just being perhaps in a friendlier environment and a safer place, especially for Americans, perhaps Canada.
Yeah. We saw the Canadian dollar skyrocket in 2009, right? As people were concerned about the banking system south of the border.
Yeah.
If you remember, I think by that fall it was, the dollar went to $1.10, which never happened in our lifetimes. 1960 something was the last time it was even above it. So right now, due to oil, you're seeing all-time lows on the Canadian dollar. I think mainly driven on there, and the fact that we're a natural resource-based economy as well. We're not as diversified. So I think you will have Americans look at Canada, especially British Columbia, being a safer place for them to invest their money or to spend their money with respect to real estate or quality of life things, because the NHL was talking about the other day about finishing the season in British Columbia because we had done a pretty good job of managing COVID-19 relative to the rest of North America. So I think people are going to look at this moving forward.
Yeah.
Right. Hi, I'd like to buy property there, and the reason why I'd like to buy property there is I think it's a pretty safe place.
Yeah. If I can just get across the border.
Yeah, that financial advisor can't comment on that one. Yeah.
Oh, that's good. Well, thanks very much, Scott. It's been a pleasure talking to you as always.
Thanks so much.
And I think that you have a few disclaimers and disclosures to let us know about here.
So anything that we shared here should not be construed as trading advice. Please seek the advice from your financial advisor. We can't sort of give or receive any trading instructions unless we get it through voice or face. So really, really important for us to follow the rules on those type of things. And yeah, if we can help out, let us know.
Okay, well, I'll definitely link your details below. So if anyone wants to get in touch with you, that would be great.
Cool.
And they can do that. Okay.
Excellent. Thanks a lot, Dean. Appreciate it.
Thanks a lot, Scott. Okay, we'll talk to you soon.